Welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. Thank God it's Friday. Welcome back. Today I want to talk about the market and where the value is and where the value isn't. Then I want to go through 3 shares to grow your portfolio in June. On top of this, members will be excited to know that we've got a new stock coming out next week. A new small cap, that's right. Hold your horses, and a section we've been working very hard on called Traders Corner. Exciting stuff. We'll be delivering all things trading, ideas from professional traders, ideas of our own. It's going to be great. It's something to look forward to. But first, the market update. Well, actually, it's a bit of a misnomer. Everyone says, what's the market doing? What's important is the economy, always the driver. So what investors are doing is hunting for growth in stocks that aren't dependent on the state of the economy. That's why we're seeing some stocks go crazy. Every day we're seeing tech stocks get bought and bought and bought in the US. We're also seeing big deals done in biotech. So this translates to big money going into a few stocks. Like, it's a bit of a melt up, if you ask me, when it comes to some of these tech giants. And at certain points, the valuations don't reflect fundamental reality. So don't worry, because there's many other stocks that are out there that are left in the fields that are undervalued because they're being ignored. That's where Under the Radar Report comes in. And I'll go into these stocks in a second. But let's look at 2 stocks where I think investors are getting carried away. I mean, this week in sub picks, we covered Weebit Nano. I mean, this stock's been around for a while, trying to develop a form of flash memory, but it doesn't look like generating revenues anytime soon. Who knows? Maybe Nvidia's looking at Weebit Nano. The thing is, Nvidia generated earnings in the 3 months last quarter of 20 billion US or something like that. Weebit Nano doesn't look like it's going to make any revenues anytime soon, yet it's in the ASX 300. So you got to question these things. Drone Shield, the one I mentioned last week, valuation nearly $1 billion. Makes around 100 million in sales. It's sort of marginal profitability, sure, but look at the share price. Basically, sure, it has a NATO contract, but it's marginal in profitability, as I said. More importantly, it's the nature of its profitability. Like, this company produces some sort of gun that looks like it's, something out of Aliens or Alien. I never know which one. But anyway, the point is, it's not software as a service. So it's not generating money from software. It's generating money from hardware. So that is a lot less profitable over time. What you want to buy are stocks that have business models that can deliver real profit growth. That's what we're looking for here at Under the Radar Report. And luckily, I've got 3 coming your way. The first, MedAdvisor, ASX code MDR. This stock has gone up, yes, but it's got a great business model. It's got subscription revenues in Australia from its app, which most pharmacies subscribe to for medical adherence. That's a fancy term for saying making sure people take their prescriptions. And that's on the Australian side, so that's a constant revenue stream. It's the US where the real sex sort of appeal of this stock resides. Like, in the US, it's basically turning itself into a marketing agent for Big Pharma. We saw 57% revenue growth in the last quarter. Like, that is something you'll never see from a blue chip. Let's move on. Silk Logistics. Well, this is probably at the other end of the spectrum, sort of old school industrial. They're the 3rd biggest port logistics operator in Australia. That gives them scale. Like, they've built that scale through acquisition. And now is the time to deliver on that scale. The point is, it's very, very cheap. It's trading on 25% of sales, single-digit PE, so it doesn't have to do much to really generate the market's attention. And it's got a strong, not monopolistic, but certainly oligopolistic position. So it's one worth watching. Third, the highest risk of the 3, Airtasker. What's encouraging, we all know about that, the taskers and the marketplace for jobs. That all sounds good, but people want to see the economic or the fiscal reality. But the good news is it's really delivering in Australia. Like, this company is generating 80% EBITDA margins from its Australian business. Like, that is phenomenal. I've hardly ever seen a company that profitable. The question is whether it can do that offshore. It's at a nervous point, in the UK. So all eyes are going to be on the CEO, Tim Fung, to see if he can pull it off. But, it's a high-risk bet. There you have it. The takeout is, don't play the momentum game. Don't pay up for stocks unless you've got enough liquidity to get out. So, if you're going to play the momentum game, play it at the big end of town. The other bigger takeout is always be on the hunt for value, because it's value that's going to sustain your portfolio over time. That's what helps you sleep at night. It's not racing in and out of potentially high return ventures, because that means you're constantly playing catch up. It's almost like a pyramid scheme. Next week, just to remind you, we're releasing coverage on a new stock in the small caps. We're releasing our Traders Corner segment. We've got our special report on ETFs. It's all happening under the radar. Great to talk to you again. Talk to you again next week.